Hi future investor, if you are looking for a company for you to invest and you didn't know which company should you invest to, this video might help you. But before that, we will really appreciate if you can spend a minute to like and share this video. Okay, to cut it short, here is the company that we would like to suggest, HeiTech Padu Berhad. If you are familiar with the ICT industry, you might come across this company. Throughout this video, we will share about the company background, fundamental ratios, weighted average, cost of capital, debt ratio, dividend policy, and of course the recommendation. HeiTech Padu Berhad was incorporated since 27 years ago and located at Subanjaya, Selangor. As I said before, this company is one of the leader in Malaysia's ICT industry. But other than that, they also involved in other sectors such as renewable energy, engineering, part database for automotive, document data processing, and defense. HeiTech major achievement includes supporting the Malaysian government in delivering mission-critical technology to general people. Throughout 27 years of their existence in this industry, they managed to secure a lot of big projects such as outsourcing of IT services from PNB, secured smart parking, and do the maintenance and technical support for MySikap JPJ. And their current share price is 0.0985 ringgit Malaysia. And here is the list of important persons that are responsible to oversee and manage this company, led by Tan Sri Datuk Sri Abi Musa Asari bin Muhammad Noor as Chairman Non-Independent Non-Executive Director, and Datuk Sri Muhammad Hilmi bin Muhammad Taib as a President Executive Deputy Chairman. Datuk Sri Muhammad Hilmi is also one of the substantial shareholder too. Here is the 5 ratios used to analyze financial information in financial statement of company. It used by the analyst to determine various aspects of a business such as its profitability, liquidity, and solvency. We will discuss in more details for each of the ratio in next slide. First is liquidity ratio. It consists of current ratio, quick ratio, and cash ratio. This ratio used to measure a company's ability to pay debt obligation. As we can see, this company liquidity ratio is decreasing, but we shouldn't be worried because this is the sign that the company is having financial difficulty for over the past 5 years. But we can see up until now, the company is still sustainable. Financial leverage is an investment strategy to increase the potential return of an investment. It consists of debt to asset ratio, debt to equity ratio, and time interest. Both debt to asset ratio and debt to equity ratio indicate companies' ability to raise cash from new debt and able to raise additional capital to grow. Only the performance on time interest ratio is not quite good as it is considered risky for bankruptcy and default. Efficiency and turnover ratio can be determined by return on equity, return on asset, and return on invested capital. Efficiency ratios measures a company's ability to use its asset to generate income. In general, since the company was affected by COVID-19, they didn't meet the benchmark of good turnover ratios. Low turnover implies that the company's sales are poor and worse in inventory management. For the profitability ratio, it used to indicate the efficiency of company to generate profit by analyze the gross margin, operating margin, earning before interest and tax margin, and net profit margin. As a result, for the past 5 years, the table show that this company is having low profitability ratio, and this is due to the operating cost and inadequate revenue. Next is market value ratio. Market value ratio used to evaluate the current share price of company stock. It can be measured by market value to equity and market to book ratio. Based on the result in this table, we can see in overall, market to book ratio for this company is greater than 1. It could mean that the company stock has performed well. This chart shows the aggressive ups and downs of stock price for the year 2017 until 2021. Changes in stock price are due to market forces. Factors that lead to fluctuations are supply and demands, financial news, natural disaster, investor reaction to the financials of the company, and also speculation on price. The moving average is very important for investors as the uptrend will act as a floor and downtrend will act as a resistance. To conclude, the ups and downs of the stock price of HeiTech Padu Berhad follow the market movement. As shown, the value of expected rate of return for HeiTech Padu Berhad is 16.6%. It aims to protect the value of an investment portfolio by investing in lower risk stock such as HeiTech Padu Berhad. It explains well that this company is conservative investment because it prioritizes capital preservation over market returns or growth. Even if the calculated rate of return is lower than any other stock with aggressive investment, it aims to maximize capital appreciation or the increase in portfolio's value over the long term. As a result, investors are able to invest in this company because it is classified as a high-risk small-cap company with a beta more than 1, which is 2.1, and the calculated projected return is 16.6%. Based on the calculation shown above, it indicates the WACC for HeiTech Padu Berhad is 15%. This means that the WACC is useful in detecting if the company's value is increasing or decreasing. It should have a higher rate of return than its WACC. This resembles on the average investment project funded by the company will have the return 15% to satisfy debt and equity holders. Shareholders use WACC as a tool to decide whether to invest. This company WACC of 15% shows the company's minimum rate of return at which it generates value for its shareholder. For every 1 ringgit invested in capital, the company generates 0.02 ringgit worth of value. If the firm's return is less than its WACC, on the other hand, the company is losing value, indicating that it is unfavorable investment. In this slide, we are going to highlight the debt of HeiTech Padu Berhad and have a few discussion on the borrowing of this company. Before going into the leverage ratio analysis consideration, let's have a quick review on the debt of the company. Within 5 years, from 2017 to 2021, the debt of this company seems to decrease and expected to have a low exposure to a business downturn. However, the amount is considered to be high if this company decides to feel safe or keeps wanted to be in the comfort zone. Based on the analysis, this company is not a really good choice to be invested in the near term by looking at the leverage ratio. Excessive debt in HeiTech Padu Berhad capital structure is hazardous, but it also has advantages. Borrowed money rather than equity capital can significantly improve a company's return on equity and earning per share as long as the rise in earnings exceed the interest paid on loans. However, long-term excessive borrowing might result in default and bankruptcy. The process that management follows in making dividend payout decision, or in other words, the magnitude and distribution of cash payout to shareholders over time, explain the terms of dividend policy. Based on their annual report, we can describe that the company implements no dividend policy. It is because any gains are retained and reinvested in the company to help it develop in the future. These practices are often employed by startups or companies such as Google and Facebook that have previously created confidence among investors. Shareholders invest in a firm that does not pay dividends in the hopes that their investment overall worth will rise in tandem with the company's growth. The class of investors who invest in these enterprises is typically younger or middle-aged people who are not as reliant on regular income. In overall, HeiTech Padu Berhad earning before interest and tax to free cash flow conversion made us worry of the stock, and its earning before interest and tax growth rate was no more attractive. But at the very least, its total liabilities are not too severe. On the other hand, we would highly recommend the investor to invest in this company for long-term growth. Since their share price currently drops, it is a good opportunity for the investor to buy the share at the lower price, as this will lead to bigger spread and higher return. Lastly, despite all the challenges and the economic situation faced by the company, they can still survive for over 27 years. This proves that the company is good for investment as it is sustainable. We hope that this video might help you at the very least and hope you enjoy watching this. Thank you for your time and don't forget to share and like this video. Thank you.